In this video, we'll walk through a simple but very powerful recipe for generating distributions of future interest rates, very similar to the one we use in our Smart Models applications. Now some say, you can't predict interest rates, so why do you bother with some fancy model? Well, our answer to that is, we absolutely agree. You can't accurately predict interest rates. So when you, as a CFO or treasurer, are stuck with a job description, which involves borrowing to fulfill the mission of your institution or public corporation, what do? At minimum, you have to pick fixed or variable rate debt, and if you knew with 100% certainty that you'd be better off issuing variable, you'd do it, right? And in retrospect, you could be wrong. How wrong could you be? Well, an interest rate model can help you determine just that. We do this not to delude ourselves that this type of model is more accurate, but rather to allow us to acknowledge that when we pick 3% or the 10-year average of SIFMA or LIBOR for our debt service schedules and forecasted cash flows, they could be quite wrong. These models give you at least an order of magnitude number indicating how far off those forecasts are. So with that, let's go through exactly what we'll be discussing in this video. First, we'll look at how rates move along, and this is a section where we'll review the drift component of our interest rate model. On average, where do rates go from one time period to the next, and how is that done and specifically calculated? The second will be looking at the volatility component. How do we introduce risk or uncertainty into the model, and what does that mean for rates as we look at them through time? And last, we'll look at different market factors, not just interest rates, but other types of variables and how they might interrelate in a more comprehensive market model solution. So first, let's look at how rates move along on average. So here we have our recipe, our formula, which might look a little imposing at first, but it's really not once you break it down. We're first going to just look at this initial term. And what this formula tells us is that the change in rate, that is the delta R, the change in rate here, is just a mean reversion parameter, which is S, multiplied by our average rate within the model, M, minus the rate from the time period prior, it's our t minus 1 here, times the time step, our delta t. So what does this mean? These all just boil down to simple numbers. So let's say we have a starting rate of 1%. Our mean rate in the model is 5, and the time step we've chosen is half a year, 0.5 years. What will this look like when we calculate it through? Here we have a spreadsheet set up with that same information. Our initial rate is 1%, our average rate is 5, our mean reversion, which we'll go through in a second, is 0.2, and our time step is 0.5. Well, what does our recipe tell us to do to calculate that drift component? So our drift component here is the mean reversion times the difference between the average rate, which is 5%, minus our initial rate, in this case 1%, times dt, which is 0.5. So 0.2 times, in this case 0.4, times 0.5. And that all adds up to 40 basis points. So absent any other factors in the model, our next period interest rate will be 140. Great, so now we've got our next period rate. How do we go from that period to the next? Now we start with our 140. We apply the same formula. In this case now our rate from the prior period is 140 and not 1%. And we see that our drift term in this second period, the second 6-month period, is 36 basis points. And again, without any volatility, that gets us from 140 up to 176. And if we copy this formula on out a ways, we see that our starting rate for each period in the model keeps increasing until we get up towards, well, 5%. And we can see that here on the graph on the lower left. We started at 1, and we sort of asymptote right up to our 5% number, which makes sense because if we think about this drift term, if the average rate is getting closer and closer to the actual rate realized in the model, this whole term is heading towards 0. And so the change of this drift component is, on average, as we move on out, moving towards 0 through time. So what drives this drift term? Well, an important component of it is this mean reversion parameter here. Mean reversion isn't a magic number, but it does, within this particular model, help us understand how quickly rates will move towards the mean that you're using within the model. So in this case, we're starting at 1 and moving towards 5. And we can see that after about 60 periods, we're getting pretty close to our 5% mean. However, if we move mean reversion down to 0.1, for instance, we see that after 60 periods, we're still not quite there yet. And in fact, even after about 70 periods. And of course, if mean reversion is 0, well, in this case, all that means is we're going to have a straight line at 1%, because now we're not drifting towards anything, and the 1% number is staying exactly where it is. We have no drift and we have no volatility. And we can see that in the presentation that we have here. Mean reversion starting at 0, this is our blue line, and as we increase that speed all the way up to 0.3, you see that we're getting faster and faster towards our 5% mean over time. So depending upon the purpose of your analysis, you may want to change that mean reversion speed to get you more in line with what the expectations are for the market. Now let's look at our next term in this formula, this recipe for generating interest rates, and that term is going to be the volatility. And volatility here, much like the mean reversion, is not anything mystical. What it really is in this context, and we consider context critically important to consider when using interest rate models or any financial models, in this setting, what we're trying to do is understand that we're forced to make an interest rate forecast by nature of the work that we do, but how wrong might that forecast be? And what volatility does is allow us to acknowledge that the forecast will be wrong, and what might it mean, how wrong could we be over time given the uncertainty related to interest rate changes, and what will that mean ultimately for the balance sheet, capital planning, credit metrics, and other financial measures that are relevant in any decision making. So here you can look at volatility as a conviction about your forecast. If your conviction is very low and uncertainty is very high, then you turn the volatility dial up. If, however, your forecast horizon is short and your conviction about your forecast is fairly strong, then you might turn the volatility dial down. And that is really about as complicated as an explanation needs to get about volatility. In the context of our specific analysis, however, we want to look at how this term influences the factors within the model. And in order to do that, we're going to go to our cash flow model, which is downloadable from the Intuitive Analytics website, and see what impact that has on interest rates and a graph there. So here we have our same input parameters. 1% is our initial rate. The average rate is 5%. Rate volatility initially here is 0. Our mean reversion is 0.2. And our periods per year actually is 1. Let's go ahead and make that 2. That way our time step will be 0.5 in years. So if we look at this graph, we see that we've got 1% moving up towards 5% over the 10-year horizon of this particular analysis. Now if we go back and use a relatively low interest rate volatility of 10%, you might use 10% for a long-term bond yield, yield volatility. We go to our rate chart, now we see that not all the lines are along that simple single path, but that we have variability, and that variability tends to increase as we go out farther and farther in time. If we go back to our inputs and put something closer to a short rate volatility, call this 40%. Well, now our rate chart has some rates getting up almost 18%. So how do we calculate this volatility term? Well, we just follow the recipe in the formula. First, our rate volatility here is 10%, and we multiply that by the rate from the prior period. And we're going to put an exponent on this rate to allow for some flexibility in the model, but in this case the exponent is just 1. What that means is two things really. First, when rates are high, in basis point terms, the volatility of rates will also be high, and vice versa. And the other nice property of this feature is it keeps rates from going towards zero, or negative rather, based upon the volatility. As rates tend to zero, this volatility term also moves towards zero. Then we multiply by the square root of time. Our time step is 0.5. And then we ultimately wind up multiplying the whole thing by the random sample itself. And in this case, we're just going to use a random sample of 1 for all of the volatility calculations for each time step. So for the first time step, we have a starting rate of 1, and we ultimately, based upon that, get a volatility of 7 basis points once the model flows through. That leaves us with a next period rate of 147. And as we follow that all the way along, we see that our volatility is increasing and moving us to rates ultimately in this particular simulation, this single simulation, of nearly 15%. This would be a high inflation scenario. If we go back and change our sample to -1 all the way across, our volatility is -7 basis points. And we've got a 133 for the next period rate. And again, our volatility is increasing in absolute terms up until it directly offsets the drift. We've got about 21 basis points of drift and minus 21 basis points on the volatility term, ultimately giving us a sort of equilibrium rate of 293, which is really representing the -1 standard deviation rate for the settings in this model. So this is a very flexible way to generate reasonable interest rates and distributions of interest rates. So this is a very straightforward model, which ultimately allows us to really create as much variability as we want in looking at the conviction we have around our forecast. So between the two of these terms, the drift term and the volatility term, we have a complete recipe for generating changes in interest rates and ultimately interest rates themselves, which we can then use to calculate cash flows from variable rate demand bonds, cash flows from investments, cash flows from interest rate swaps. And with that, we then have the ability to look at different structural alternatives which might reduce our cash flow variability, because that's always a good thing when analyzing debt structures. We want to minimize the variability and uncertainty related to the cost of carrying debt, but at the same time, we want to reduce the expected level of those payments to service the debt as well. And so this ultimately leads us to very interesting optimization problems where we're trying to decrease both the distribution, the width of the distribution around debt service payments, but also the expected level of those debt service payments as well. And we'll leave that as a topic for another video. Thanks for watching this description of the interest rate model, very similar to the one we use in Smart Models applications. If you have questions on this or any other topics related to this type of modeling, please shoot us an email or give us a call.